According to a study, reinvesting dividends can increase your total return by up to 50% over a 20-year period. This highlights the importance of dividend reinvestment as a tool for building wealth and achieving your financial goals. When you invest into a company that pays you a dividend, you have a choice of either receiving that dividend in cash or reinvesting that dividend back into the company. And this can be done automatically. When you're deciding to reinvest your dividends, you're essentially choosing to buy more shares of that company, which can then help grow your portfolio faster. So if you invest in McDonald's and they pay you a dividend, you can then say, actually, I don't want this money in cash, I want to use it to buy more McDonald's stock. You can either use the dividend to buy more shares in the company that actually paid you that dividend, or you can use that money to actually buy shares in a different company that you have in your portfolio. Deciding to buy the same company is easier and it can actually be done for you. But deciding to manually reinvest your dividends yourself and deciding which companies to buy gives you a little bit more flexibility. Maybe you need to up your exposure in a certain sector, so you decide to use your dividends to buy a company in that sector. Or maybe a different stock is trading at an attractive price and you want in on that action. So why is dividend reinvestment so important? Well, there are a few key reasons. The most important reason is that it takes advantage of compound interest, which is building interest on your interest. When you're reinvesting your dividends, you're using the earnings to buy more shares of the underlying stock or fund. As a result, you can potentially earn dividends on your new shares, which can compound over time and increase your overall returns. For example, let's just say you own 100 shares of a stock that pays £1 dividend per share. If you decide to reinvest those dividends, you're going to use that £100 to buy more shares of that stock. And when that company next pays you a dividend, you're going to receive dividends on the original 100 shares plus the new shares that you've purchased. And this process just repeats itself and increases your returns over time. The crazy thing here is it's not a straight line. It compounds and increases exponentially. It's important to bear in mind that compound interest can work both ways. If the value of your investment decreases, you could end up with fewer shares and lower returns. However, by reinvesting your dividends, you're increasing your chances of realizing higher returns over the long term. When I was researching for this video, I came across many studies that back up the power of dividend reinvestment. And I want to share 3 of them with you today that show that dividend reinvestment can increase your returns and boost income. The first study is the one that I mentioned at the start of this video, which showed that reinvesting your dividends can increase your total returns by up to 50% over a 20-year period. The second study showed that reinvesting dividends increased total returns by 2.5% per year. And the final study showed that reinvesting dividends can increase your annual income by up to 20%. I've forgotten the details of this study, but I've put it here in front of me. So that last one that I just mentioned analyzed the performance of the S&P 500 index over a 20-year period. And they found that reinvesting dividends increased the total returns by approximately 2% per year. And that was compared to receiving the dividends in cash. So just to hammer this point home here, I wanted to share this graph, and all 3 of these lines on this graph are of a $1,000 portfolio that's been invested and left for 30 years. So this blue line at the bottom here represents a portfolio of stocks that had absolutely no dividend reinvestment. So what you'll see is it obviously started as $1,000, and at the end of the 30-year period, the portfolio was worth $2,000. So although it did double, it wasn't very impressive over a 30-year span, and it had a very low 2.3% annual return. The red line is interesting. It represents the same $1,000, but this time dividend reinvestment took place. In this line, there was no growth, so the stocks weren't growing, but the dividends were being reinvested. And in that situation, this portfolio grew to $4,500. So even though there was no growth, that dividend reinvestment strategy allowed it to increase to $4,500 compared to $2,000 that we saw on the blue line. And this equated to a 5% annualized return. And that just proves the power of dividend stocks, but especially dividend reinvestment. And the green line is where it gets really, really interesting. And this really shows how powerful dividend reinvestment can be when it comes to dividend investing strategies. And this portfolio was firstly of growth stocks. So you're seeing that growth in the stocks that this portfolio has, but also dividends were being reinvested. And these 2 factors together allowed this portfolio to reach $9,000 over the same time period. and this actually is a 7.5% increase every year. The next point is that dividend reinvestment allows some cost averaging. By reinvesting your dividends, you're buying more shares of the same stock at different price points. This is only really true if you have a DRIP, so a dividend reinvestment plan, where your broker automatically purchases more shares of the same company when the dividend comes through. Or I guess you could do it manually, but you would have to reinvest those dividends as soon as it comes into your account. If you manually reinvest your dividends and you somewhat try to time the market, or you just keep that money in your account for a few days whilst you decide what to buy, this point may not be as valid. But anyway, this can help to reduce the overall risk of your portfolio and smooth out any market fluctuations. For example, if you reinvest your dividends every single month, naturally you're going to buy more shares at higher prices, and some months you're going to buy shares at lower prices. This can help you average out your cost per share and potentially improve your returns. The next reason it's so crucial to reinvest your dividends is because of increased income. As your portfolio grows, you're going to start earning more dividends. And then if you reinvest those dividends, you're growing your position, which obviously leads on to a higher income. One benefit of reinvesting your dividends that gets overlooked really easily is what it can do to you psychologically. By choosing to reinvest your dividends instead of getting them in cash and spending them, you're committing to this long-term mindset. And this can help you stay the course and not be swayed by short-term market fluctuations. A long-term perspective is important in investing, as it helps you to ride out the highs and lows of the market and achieve better returns. There's one more reason why dividend reinvestment is so important. I'm going to tell you that, and then we're going to talk about some situations where actually you might not want to reinvest those dividends. Dividend reinvesting can also help you diversify your portfolio. It provides you with an opportunity and encourages you to go out and buy a variety of different stocks across many sectors. You obviously have to want to do this as well, of course, but this essentially will reduce your risk and increase your chances of success. According to a study done by Vanguard, diversifying your portfolio can help you achieve better returns with less volatility. Reinvesting your dividends is really important, but there are definitely some situations where it just may not make the most sense. The most obvious one is when you actually want to live off of your dividends. If you're relying on your dividends to pay your bills and sustain your lifestyle, such as in retirement, you're probably going to want that money in cash, and you're not going to want to reinvest it back into your portfolio. Or perhaps if you've already reached your financial goals. If you've already managed to accumulate enough money to meet your financial goals, you might not need to reinvest the dividends to actually achieve any more goals, and you might decide to do something else with that money. Another reason why you may not want to reinvest your dividends straight away is if there is overvalued or expensive stocks in front of you. Perhaps the market is just doing really well at the moment, and you want to instead hold on to that cash and wait for an opportunity to present itself. And this leads on to the next one, which is alternative opportunities. If you come across a particularly attractive investment opportunity, you may decide to use your dividends to invest in those opportunities rather than reinvesting them into your portfolio. And lastly, tax considerations. Depending on your tax situation, and this is really a personal thing, you actually may be better off receiving your dividends in cash than deciding to reinvest them. I'm going to do a video very soon on how dividend tax is changing in the UK and why ISAs are more important than ever, so watch out for that one. If you can add any more reasons why dividend reinvestment is so beneficial, then please drop them in the comments below. Thank you for watching. I'll see you soon.